Welcome to the January 2026 IndiView Market Update and Outlook. I'm Jeremy Bryan, and this is powered by IndiWealth. Today, we're going to take a little bit more robust look at just the overall markets. We're going to talk a little bit about 2025, the good and the bad, mostly good, to be honest with you. And then we're going to take a look at kind of a snapshot of the economy and see where we are from that perspective, see where we are from a stock and bond perspective, and then talk about our path forward, which is our outlook and positioning. So let's get right into it. Let's talk about asset class performance year to date because it's been very, very strong. It was very, very strong in 2025. I shouldn't say year to date anymore. It's over. But 2025 was a strong year almost across all asset classes. Almost everything worked. Let's start with the S&P 500. We were up 18% in 2025. Great year in the markets. But actually, the S&P 500 lagged its international counterparts for the first time in a while. So I like to look at the ACWX, which is the all-country ex-US. So basically anything outside the US. That performance was up 32.6% in 2025. That's the best performance since 2009. So a really, really strong year for international stocks. Turning to the lowest one on here is actually 7.3% for fixed income. It's the lowest on here, but that's a pretty good year for bonds. If you can get 7.3% out of your fixed income, you've had a pretty good year. So despite it being the lowest, that's actually a pretty good year. Again, the long-term average for the stock market is 8 to 10%. So getting 7% out of fixed income, strong year. I kind of call 2025 the year of diversification, right? Where diversification actually showed up. Because for a while here, for the better part of, almost 4 of the last 5 years, diversification, you've had a lot to apologize for because the US market has been so much stronger than almost everything else. Having a diversified portfolio this year was a pretty big benefit. So if you just look at a balanced where you had a little bit of everything and kind of a 60% stock, 40% bond allocation, you did 16% this year. So it's almost the S&P 500 in and of itself with a lot less risk. If you also included some precious metals in there like gold and silver, those had phenomenal years in 2025. So those would have added incrementally. One that would not have is probably your cryptocurrencies, especially Bitcoin. Bitcoin had a difficult 2025. Had a great first half, but then the second half kind of waned. So that one probably didn't help you much. But outside of that, if you had diversified asset classes, you really had a broad swath of a lot of things working for you in 2025. So let's talk about our scorecard. We provide outlook and positioning here at IndiWealth. And so we think it's valuable to take a look back at what we said and where we were right, where we were wrong, kind of analyze it for the position going forward. Always with the caveat that none of this has a specific timeline. But when we introduced it to now, we like to say, how did that look? And would we continue to do that? And that's what this is for. So let's talk quickly about what we got right. Political noise and rhetoric, will it subside? Not likely. We were absolutely right about that. I would have the contention that the markets and politics right now, your noise level is about as high as it gets. That we look to the administration for a lot of what's happening in the markets. Some years we don't, some years we do. 2025 seems to be, we spent a lot of time trying to analyze that. I honestly don't think that adds a lot of value to portfolios over a longer period of time, but no question that the abundance of news and political volatility was high. But it really didn't affect the markets much. I showed you what 2025 did as a pretty strong year across the board. So despite all that news and volatility, the markets continued to work. We also said all-time highs are not a reason to sell. We absolutely still believe that. And we were justified in making that assertion in July. So if you just look from the end of June to the end of December, when we were nearing all-time highs when I said that, the S&P 500 using a proxy of SPY was up over 11% from June to December. ACWX was up over 12%. And the bond aggregate, AGG is what I use for that proxy, was up over 3% during that period of time. So staying invested was profitable in the second half, even as we entered all-time highs. We still believe that today, that all-time highs in and of themselves is not a reason to sell. Lastly, on the what we got right side is U.S. stocks. We talked a little bit about the opportunities in healthcare. We said, hey, the band is just stretched a little too far here, is that these are still good growth companies and they were relatively cheap. That was our analysis and argument at that time. Turns out the market started to agree with us here, is that healthcare was the best performing sector in the S&P 500 from the end of June to the end of December. So we did good there. Where we did a little less good is we also talked about recurring models and consumer staples. Consumer staples continued to struggle in the second half. I think what you saw there was that K-shaped economy that we've talked about ad nauseum here. With regard to the mid to lower tier consumer feeling a little bit of strain of increased prices and all the other stuff and potential job loss. I think that affected the staples company. So staples didn't perform nearly as well as healthcare did, but healthcare was a strong performer. Turning to more of what we got wrong, I think we talked a lot in July and honestly through the rest of the year about the importance of kind of rebalancing. Is that we were having a strong first half of the year and we said, hey, your risk might be getting skewed a little bit higher, both in the bond and the stock market. It's probably prudent to bring that back to equilibrium and maybe even a little shy of equilibrium. Well, just from a perspective of from the period we set it to the end of December, that would not have made you money in either side. Is that longer duration or longer maturity bonds and the ones with credit risk actually outperform short-term treasuries. So the stuff that we were saying to rebalance and maybe shorten your time frame didn't work quite as well as the stuff that had higher risk to it. Same thing goes in the stock market, is that, saying rebalancing and getting to these defensive recurring models, that actually helped a little bit just because the Mag 7 stocks, the big ones in the S&P 500 were the big drivers of the first half of 2025. They weren't quite as much of the drivers of the second half of 2025. It's a little bit more broadly diversified. So it helped a little bit, but overall, risk generally paid off in the second half where we were saying, rebalancing. If you didn't rebalance, you probably would have made a little bit more money. We think it's still the more prudent strategy, and we'll talk about that more on the path forward. Lastly, on the international stock side, what I thought was interesting here is we were talking about in July and October saying international stocks, if the US dollar were to revamp and get stronger again, it could lead to a correction in international stocks because the US dollar was a significant tailwind for the international stocks and the businesses that are within there. Turns out they didn't mean them as much. The US dollar strengthened a little bit. It didn't go crazy right back up to where it was before, but it stopped going downward. And international stocks continued to work. In the back half of 2025, ACWX rose by 12%. So again, it was up 30% in the year, so it had a stronger first half, but it was still rising. And we really didn't get a sense of that big level of correction in there that we were potentially anticipating from the dollar strengthening. So we were pleasantly surprised with that. We own an allocation to international stocks, but we did not see that level of correction that we talked about. So now we're going to pivot gears and talk about more a snapshot of the economy. Where are we at right now? And we'll start with GDP. GDP, if you look at 2025, we started out slow, no question about it. We actually had a negative. I think Q1 was actually a negative number. Q2 accelerated to 3.8%. Q3 was 4.3%. That's pretty strong. And the estimate for Q4 25 as of right now is 2.7% growth. So we rebounded and we actually probably had a stronger GDP number than, frankly, I think most expected, and certainly us. We expected slower than average growth. We probably got average to slightly above average growth over that period of time. So depending on where Q4 25 shakes out would tell you that, but we had at least 2 quarters where it was above average. Now, what I will tell you is here at IndiWealth, we use GDP as much more a historical measure than we do a future predictor. What we tend to try to do is look at the components that build up GDP, jobs and spending and that kind of thing, to say what our growth would look like and the engines of that growth look like, rather than saying GDP is going to be 4% in 2026, right? We don't really, aspire to do that. What we would say, though, from a GDP perspective is we would expect, again, that average to slightly below average growth. Again, from a job sentiment, which I'll talk about here in a minute, I think that's probably the predominant driver of why we would expect that. But again, from our perspective, it's much more what are the components of it and what are we looking at there that drive GDP rather than saying GDP in general. So unemployment rates, I just said we were going to talk about jobs. Let's do it. Unemployment has been rising, but it's still below long-term averages. So you can see the U3 unemployment here, which is about 4.6%. That's the most broadly analyzed number. And so that 4.6% has been, you can see it's coming off the bottom. It's coming off an extremely low bottom. That's among the lowest in a 50-year history. But it is coming up. 4.6% is still, it uses the average here about 5.9. I think that's a little skewed high just simply because an average takes into 2020 when everybody was told to go home and sit and not do anything. But the median number is probably in that 5 to 5.5% range. So we're still below that. We're still below long-term averages. So it's still a relatively healthy environment, but it's worsening. So if you look at monthly non-farm payrolls, the median growth of those during that period of time, from 2015 to 2025, about 219,000 jobs added per month. The median growth in 2025 was 68,000. Now, again, I put incomplete on there. I did that specifically because incomplete means we got kind of muddy numbers in October and for November, and that includes an estimate of December of 55,000. We'll see if that ends up being accurate or not. But just kind of building, the back half of the year wasn't great because of the government shutdown and the data we got, and then also using a consensus number. So it's not perfect, but I think it's pretty safe to say that we grew at a sub-average number. We were still growing jobs, but just not as fast as we had been growing them since 2015. Our opinion of this is that continues in 2026. The simple reason for that is we think companies are still trying to get their hands around what artificial intelligence will do for them from a productivity perspective. And so what productivity means is getting more out of the same worker, right? And so if they think they can get more out of the same worker, they're not going to hire as many workers because they think they can get that or more. I still think they're trying to figure that out. And then secondarily, and again, I talked about it before, the K-shaped economy, where that mid-tier to lower tier has a little concern. It tends to be kind of a rotating circle, right? Is that they have a little bit more concern about their jobs. It tends to be what's going on right now is, I heard it talked about today, and I absolutely agree with this, is a low hire, low fire environment. Is we're not adding a lot of jobs, but we're not firing a lot of people yet. But that does have some influence on, again, especially the mid-tier to lower tier income household. Job is a big part of how they feed their families, right? It's the biggest part. And so if there's sentiment around worrying about that, there may be lower spending, those kinds of things. And then artificial intelligence has that combined with employers saying, well, if their consumer's not feeling so good, I don't know if we want to hire a bunch of staff to, satisfy something that might not be there. I just think we're in a slower growth morass here in 2026 in the job market environment. As we go through the year, that may absolutely change. We may hit a dip and we may accelerate off of that and those kinds of things. For what we can see right now, we think it's slower than average growth. We would not expect that 219,000. We would expect more of what we saw in 2025 and maybe even a little bit worse. Turning to prices, that's what CPI is. Consumer Price Index, think this is inflation. So the real basic story is that core and headline inflation are still above their long-term targets. 2 to 2.5% is what the Fed sets as kind of a long-term inflation target. We're still above that. We're not high above that anymore. We're certainly not at 7, 8, 9% when things were getting way out of hand, but we're still above that territory. And what makes this unique is that we had 3 interest rate cuts in 2025 during a time when inflation was above its stated target. It doesn't happen very often. So a little bit of a difference there. And I'll talk about that when I talk about the Fed down the road here, but we're still above average. Now, turning to tariffs, again, just looking at these numbers here, there was a ton of rhetoric about tariffs and the reacceleration of inflation and those kinds of things. We just haven't seen it through the numbers yet. Now, again, we're still above average. So we're still above that area that we want to be in, the sweet spot that the Fed is targeting, that 2 to 2.5%. We're still above that, but we're not dramatically above that. In these numbers, especially right now, we haven't seen those numbers incrementally climb. There's a lot of reasons for that at this point right now, or a lot of analysis given as to the reasons, whether it's the changes and all the adjustments that have been made, the forgiveness and the adjustments and all that fun stuff. Whatever it may be, we're just, the rhetoric of tariffs was much higher than the actual influence that we can see in the inflation numbers. Our opinion, though, is that affordability will continue to be a concern. And the reason I say that is a couple things, is that the closer to nearer term data, electricity and food remain stubbornly high. And those are big components for, again, that mid-tier to lower tier household. That's a big component of their overall budget, is how much they're spending for electricity and how much they're spending for food. Both of those things are starting to accelerate again. Electricity, part of, a catch-up trade or whatever you want to do from, the state and the regulated electricity companies, having a battle out there to a certain extent, but also the data center influence. You can't ignore it completely. I think it's somewhat overblown, but that you can't ignore that the data center explosion is causing a lot of electricity and worrying about concerns there, and also increasing pricing. Food, again, whether that's tariffs or whether that's other things, you have seen kind of it normalized itself for a little while, and now it's kind of creeped its way back up. Could we stabilize that and get back down? Absolutely. But it is at an area right now where I still think affordability is a bit of a concern among the mid to lower tier households. The one I want to watch out for is oil and gas. I think that's an area we have to be cognizant of. It's been a tailwind so far. 2025, oil prices were in areas where it's very good for us. If we continue to do that, that's absolutely fine. These things can be volatile, though. Venezuela didn't really do as much as, we had anticipated or potentially could have done. It seems the market took that with a grain or block of salt. But we have to understand that oil and gas prices have been a benefit for us so far. It's been a tailwind. They've been pretty cheap. That can go the other way. And that acts as a tax. If that does go the other way, if that gets more expensive, that acts as a tax on the consumer, because you still want to do the same stuff. You still got to go to work. You still got to drop the kids off. You still want to take a vacation every now and then. If those things get more expensive because oil and gas is rising aggressively, that could be a really difficult spot for the consumer. And so I think especially with midterms coming up here in 2026, we're going to continue to hear a lot about affordability issues in the U.S. market. The Fed funds rate. Turning to the Fed here, we had 3 cuts in 2025. When we were looking through, we said a little bit more than 1. So we thought 1 to 2 was probably accurate. We got 1 more than we anticipated. What I would say from the decline is it became, the 3 cuts probably came from over exuberation. They had to control inflation, right? Inflation got out of hand, so they got aggressive with it. And so they're trying to reduce some of that aggression that they had before because inflation is more controlled. Again, it is not in their targeted sweet spot, which was interesting to see 3 cuts during a time of higher than average inflation. I think what's going on for the most part is they're saying, the inflation number is not bad enough that we can start reducing some of the restrictions we've had. And we really, they have a dual mandate. They've got the inflation side and they've got jobs. And I think they were worried enough about jobs and the low hire, low fire environment to say it's probably worth reducing some of the restrictions and the tightening that we're doing in the economy overall. So I think jobs superseded inflation, I think, is what the predominant source was. And that's, from commentary from Fed governors. Speaking of Fed governors, Fed Chair Powell, his term ends in May 2026, and it's pretty high consensus right now that he's likely done. I don't think the administration has any interest in bringing him back, and I don't think he would take any stance to extend his term for any particular way, shape, or form. So we're probably going to have a new Fed governor in 2026. We'll see what happens. I have an opinion here in a minute, but let's see where we are right now. What is the market predicting? And the market as of 1/6, 85% probability of no Fed move in January. I think that's right. And here's what I think is that I think this early first half, they need to see what those 3 cuts do, because those aren't instantaneous into the overall economy. In the markets, we tend to react to things instantly when those come through, but these can be delayed as far as what their true effect is. And so I think the Fed now wants to say, okay, we did 3. Let's see what 3 actually does for the next couple of months. And I think only data that becomes progressively worse, whether inflation starts to reaccelerate or whether jobs really start to deteriorate, would be the thing that would pull them out of kind of staying the course for the time being. So while you always hear data dependent, and I think they should always be data dependent, I think they are very data dependent right now. I think they're going to have to be pulled out of this movement for a little while. Market still says a 78% probability of 1 to 3 cuts. So it's kind of mixed between 1, 2, and 3. But if you combine those together, it's about 78% probability. We'll see. We'll see. I think our opinion here is that I think the first half is going to be largely lack of activity. And then as we start to hear about who the new Fed governor will be, whether that's appointed and whether it's approved and all that stuff, as we go through that process, I think there's going to be pretty immense pressure if we're still in the same spot that we are right now for that Fed governor to be less restrictive on rates and to add more cuts. We'll see how this goes. Again, the data dependence could go in various directions, changing this entire thing fairly quickly. But as of right now, I don't see a lot of activity in the first half, but I think the second half is more likely to see some of that reduction in interest rates if we're in the same spot that we are right now, just simply because that's what the administration has been pushing for, and that's who they'll be electing as, or they'll be putting forth as a nominee for the next Fed governor. Let's talk about bond yields. Bonds were good in 2025. I said it before, 7.3%. It's a great year. The yields fell across maturities. So U.S. Treasury yields were pretty much down at the short end and the long end in 2025. That's good for bond prices. That was the biggest tailwind, I think, to bonds overall in having that 7.3% performance. Remember that inverse relationship. Yields go down, prices of your existing bonds go up. Yields go up, prices of your existing bonds go down. Now, where are we at in yields right now? So if you look at this data, so this goes back to 2009. Our yield to worst, which is kind of, hey, this is what our yield would be in a bond, right? Looks like above average with everything except for high yield. What I would tell you is I think this data is somewhat incomplete. The average since 2009 is those gold diamonds or whatever color that is. I think those are artificially low. And so because 2009 to 2025, we had a significant time where we were in a zero interest rate environment. That's going to affect your averages, right? When you're at zero for a long period of time, it's kind of low. So what I did is I looked at an investment grade, and I did find that 2009, 2025, it was about that 3.8% range on average. If you go back to 1996, it's more like 4.8%. I would find that to be probably pretty consistent across the board, is that I think the yields we're at right now, if you take a longer term lens, are about average. There's nothing wrong with average. And I still think bonds have that component to them, as saying it's going to reduce your volatility and you're still going to get some income generated from it. Is it opportunistic? Is it a high relative value because we're above average since 2009? I have a little bit harder time with that. I think we're at average levels right now. And I would say even maybe sub-average when you're talking about taking more risk in the bond environment. So our opinion on bonds overall: maintain a conservative stance, look for relative value, see where you can find pockets that are paying you a little bit more for not taking a massive amount of risk, but don't just blindly add risk to your bond portfolio. That's not what it's there for. It's there to provide income and to provide some ballast against the stock market. Turning to the stock market, let's talk about earnings first. If you heard me talk before, if this my biggest assumption overall is that earnings growth in the S&P 500 are the highest correlation over a longer period of time. On a year-to-year basis, this does not work, right? If you expect 15% earnings growth, don't correlate that to having 15% return in the stock market. Say, we have many years where earnings estimates actually are flat to zero and the stock market works very well. And we have also other years where earnings growth is high and the stock market doesn't do very well. So on a year-to-year basis, it's tough to do that. But over a longer period of time, earnings growth of the S&P 500 and the performance of the S&P 500 are pretty highly correlated. So 2025 earnings growth, 11.5%. That's a really good year. It's above average. It's a great year. What was interesting is the estimate numbers, they kind of bottomed in that June, July timeframe when we first started talking about this, and then rose up a little bit in the back half of the year. People started to get more comfortable with that growth level. I think that came from companies as companies started to report and saying, hey, things are working out a little bit better than we anticipated. We were able to add some or reduce some cost, and our earnings were better than expected, and the numbers followed suit. The other thing is the S&P 500 net profit margins continued to rise. That's the interesting part here to me, is that if you look at 2026, the net profit margins are expected to be the highest ever. So if the number comes true, it'll be the highest we've ever had. Now, I say this with a grain of salt because that happens all the time. If you look at net profit margins going back to the 80s, what you find is that in growth phases of the markets, net profit margins are continually beating their prior highs. And then in recessions, you have a reset and a pretty aggressive reset. And then it starts to go back up. It exceeds the prior highs from before, and then it exceeds more highs again. And then recession, and you do it again. So there's that component. That I think that's the cyclical area. So saying net profit margins are going to be as high, the highest ever in 2026 isn't as scary as it sounds. But what I would say is we maybe need to be a little bit cautious on the growth rates we're expecting. So our opinion is that 2026, the estimated growth right now is 14.3%. We think that's a little high. Now, we said 2025 was going to be a little high too. We ended up being, I would say, more wrong than right about that. It ended up being pretty close to what they anticipated at the beginning of the year. But I think to accelerate off this number in a jobs environment that's not going to be as good, I think is a little overly optimistic. Now, again, if this number goes down to 12, 11, 10, it's not a huge headwind for the markets. It's a bit of a headwind, but it's not massive. In fact, it kind of sometimes happens that way. If that number ends up going from 14 to 10 to 10 to 5 to 5 to 0, then it's a bigger problem. And that's where you could really start to see some market tail over because of the valuation of the markets currently. And that's what we're going to talk about here is the S&P 500 is expensive compared to history. It can be expensive for long periods of time. Look at the 2000s area, that bubble peak, it was expensive when it hit 22 and it got to 24 and a half. I would not foresee that as the base case scenario here. What I will tell you is that valuation doesn't tell you a whole heck of a lot about what 2026 is going to look like. It's a poor predictor of performance in a 1-year time frame. What it is a better predictor of is 3 to 5 to 7 years out. And so as a result, I think we should be expecting sub-average returns when we're paying more for stocks. On the other side is when stocks get cheap, like in that 14, 15, 16 range, then we can probably expect average to above average returns. So from my perspective right now, I think this is the biggest predominance that I use valuation to say our longer term, if we're saying 8 to 10%, probably should take a little bit of a haircut on the long-term return of that. That also correlates well with, just frankly, we've had really, really strong markets over the last 4 and 5 years. We had one really difficult year in 2022, but outside of that, the market's been pretty strong in the 2020s. Can that continue? Absolutely. Should we expect that as our base case scenario? Probably not. The Wall Street strategists are arguing that these are justified based upon productivity gains and the tax relief we're going to see in 2026. Sure, there's a component of that. It could absolutely happen. I just always am a little careful about different this time analysis. So from my perspective, I don't think the historical average of 16 times is probably correct for this environment. We are more productive. We have a higher net profit margin. We're growing pretty fast. The companies that comprise the big companies, the S&P 500, are growing really fast. So it probably should be a little higher here. But, in 2022, we were down to 15.7 times. When we got, a little bit depressed about the things that were going on, the valuation went down pretty aggressively. Getting down to 15.7 times, even with no change in earnings. So let's say you get this 14% earnings. If we went down to 16 times, that's a 32% decline in markets. So just understand that valuation can have a pretty big driver, but trying to use it as a prediction tool and a timing tool, really, really difficult to do. So understand that, again, I think longer term averages are probably at substandard or sub-average levels. That should be the expectation rather than saying, oh, valuation's high, 2026 is going to stink. I think that's harder to do and not something we would take here. So let's talk a little bit more in general terms again, because I'm asked all the time, do you think the market's going to have a pullback? The answer is always yes. Yeah, I just don't know when. I wish I could tell you, but that's the bigger part. It's absolutely going to have a pullback. I just don't know when it's going to happen. They happen all the time. So for those of you not familiar with this chart, the bar component with the high number for the most part is the end of year performance for the S&P 500. The dots that are all below that area are the worst performance intra-year. So how far were we down in that year? You can see that we always have 5% corrections. We always have 10% corrections. We had a 20% correction in the markets in April of last year in a market that we did, almost 18%. So it happened all the time. And it will happen again. It will happen, and there will be some level of correction in 2026. It's the rare instance, like your 2017, where you had a 3% was the worst. That's the rarity. Usually you're going to have at least 1.5 or greater. Most times you're going to have a 10% or greater during the year. But the odds are still significantly in your favor. If you look at 1980 to 2025, which comprises this time frame, look at all those corrections during that period. Look at all those declines and pullbacks. Yet the annual performance is up 78% of the time. 78% of these years are positive at the end of the year, even though almost every year has a pretty significant correction. So what I take from that is pretty simple. Pullbacks are painful. They don't feel good when you're in them, but planning can reduce the harm of that. That's how you do an investment plan, is you plan for a little bit of a rainy day, but you also want to reduce that harm so that you can stay invested. And really, that's how you achieve those outsized returns over a longer period of time in the stock market, by staying the course of your plan rather than panicking at the worst possible times. And this goes to show, again, this is where we talk about your time matters. We talk about it all the time. We think time-based components of risk are the most critical assessments about what you can do, because the shorter the time frame, the wider the outcomes. And this just shows that in 1, 5, 10, and 20-year periods. Look at your 1-year stock. Your average is 13%. Great. Wouldn't bank on that, though, because your best performance was 60%. Your worst performance was minus 41. That is a very, very wide level of outcomes to say, oh, I can count on the average. I don't think you can do that. The longer you go out, though, the tighter that range gets. As we look at 20-year periods, even 10-year periods, your worst 10-year performance in stocks is minus 4%. It's not great, but it's not a disaster. And your average is 11. So your average is closer to that range. Your good outcomes and your bad outcomes are just closer together. And so from a short-term perspective, I think you need to increase your certainty. It reduces risk, and it allows you, especially if you have an expense need coming up, you don't want to be taking excessive risk. You can't have a minus 41 and expect to be able to pay your bills in the next month. But if you can have if you live through that minus 41 because you have some short-term assets that take a lot less risk, you can embrace that uncertainty for higher reward by extending yourself and earning the achievements that come from taking that higher risk. You should always be compensated for your risk, but it depends on your time frames of how much risk you can take. Lastly, before I get to the path forward, I'm going to talk quickly about this. Midterms are coming. This just really gives information about why we don't use politics as the biggest influence or even a very large influence on our portfolio decision making. 1, we have no control over the outcome. 2, we have no real accurate forecasting mechanism for that outcome. And 3, we have no real case that even if we know the outcome, we know how the market will react to it. All of those things say don't put politics in your portfolios as an assessment over longer term performance. How this proves that is on the stock markets and presidency side, red and blue, you make green. I mean, the market just kind of continues. The market is made up of companies, and U.S. companies are amongst the most efficient and adaptable on the planet, because if they're not, a new company will take their place. And that's what the S&P 500 proves over longer periods of time, is that politics can have an influence, but over longer periods of time, it's those good companies that can be efficient and adaptable will be successful, and they become bigger parts of that index, and the index works. Turning to the other side is the S&P 500 performance. This is a little dated. It's 1950 to 2023. Honestly, it just helped in 2024 and 2025. Those are both good years. Look at these numbers. So a Democratic president, your worst case scenario is they're together, and that's 8.72%. But your average, 15, 14. Republican and Democrat, the split, that's affected a lot by the Bush years that basically went nowhere because we had 2 calamities in a 10-year period. But outside of that, those numbers are very accurate over a longer period. So again, using politics as your influence for how you're going to invest usually erodes rather than exceeds. So we would say that that should not be the biggest, nor even a big influence on how you invest over longer periods of time. So let's finalize with the path forward. Let's start with the outlooks. Geopolitical risk higher in 2026. I think that's we're taking that as the assumption. Venezuela opened the door to that almost immediately, right? Is that it turned out from a market's perspective, at least right now, not very big avenue. But it does increase the risk. We still have active wars going on. We still have a lot of things that have not been solved. And I think that that is not going to go away. And as a matter of fact, it could actually potentially increase in 2026. Will the markets care? That's the biggest thing, is that we've seen it work through multiple geopolitical risks so far. It has a short-term burst and then goes back up. And that tends to be the case over longer periods of time, unless you get contagion effect. And then the worries can actually present themselves in both an economic and market perspective. So have to be cognizant of it right now, but I would expect equal to higher geopolitical risk in 2026. The Fed, I talked about it already. I think the first half is relatively low activity, and the second half, with a new governor installed, likely gets probably more cuts if we're in the same scenario now. Again, we have to be as data dependent as the Fed is. So if we start to see a massively different economy than we're experiencing right now, then that should obviously change what our assumptions would be. But based upon right now, we see them trying to assess what's happening. And then as a new governor takes place, and especially administration who they're nominating, it's more likely that they would be likely to be more forgiving and less tightening in the overall economy and for Fed interest rates. Jobs, I've talked about it already. I think we're in slow growth mode here for a little bit. I think consumer spending uncertainty is going to stick with us here. And it's certainly going to be talked about a lot more, right? We have midterms coming. So there's going to be a lot of pressing about what's going on in the economy, why we can't afford things and all that stuff. So it's certainly going to be much more prevalent there. And I still think that uncertainty, unless we start to see acceleration, I just think that those kind of feed off each other right now. And I think we're in a relatively low growth area of jobs. Housing affordability might get slightly better because I do think interest rates probably are equal to slightly down from where they are right now. I still think activity is going to be pretty muted there. I don't think that there's a lot of incentive for people to go out. Your debt to income is still, your mortgage debt, your housing affordability numbers, they're getting better because interest rates are coming down, but they're getting better off the worst numbers in history. So we're not affordable at this point right now from a housing perspective. And I think you're starting to see some of the younger generation acquiesce to that and saying, you know what, I just can't afford it right now. I'm gonna concentrate on other things. So I just think activity, we're still in too far apart of an area right now. There's not a lot of incentive for people to move because they have low interest rates or no mortgage at all. And the prices are just still too high for the people that want to buy. So I think we're just in low activity mode at this point right now. Bond yields, again, I think spreads are very thin. The amount of premium you're getting for taking on credit risk is low. And I am cautious about investing aggressively into risk when I'm not getting paid to take it. So I'm a little bit more cautious there. Rates will probably be a little bit of a tailwind. We think they're equal to slightly down in 2026, but not as much as 2025. So I don't foresee that as much of a tailwind for bond prices in the next year. Stocks are expensive. I don't think they're priced for perfection. I don't like saying that, but I think they're skewed towards lower than average returns. Valuation is just very high right now. International to US, now we had significant outperformance in 2025. Could that continue in 2026? Absolutely. The reason I say that is this tends to be glacial in pace, right? Is that US outperforms for a long period of time, then international performs for a long period of time, then US performs for a long period of time. It's been about the longest stretch of US outperformance that we've gone recently through until 2025. So could that be changing the other way? Absolutely. Now, I'll caveat that with is I still think US companies are probably, especially on a technology wave, probably the best positioned, better positioned than European counterparts and emerging market counterparts. But that change could be long-term in nature. And I think international stocks are still really under-owned. So I would still have them part of my portfolio. Alternative side, I think we're going to have correction in gold and silver at some point. I can't tell you when, but those things have just gone parabolic. And I don't think that lasts forever. These are sentiment-driven trades, and there is some demand behind it, but I think a lot of this is sentiment-driven. So I would be careful about extending that into 2026. Real estate has been dormant for a few years. I think there's an opportunity there, especially if rates are coming down, like we've said. I think there might be an opportunity in real estate. I wouldn't go aggressively in there, and I would be picky and choosy about where I was. I wouldn't just say broad real estate, because I still think office has some concern. I think apartments could potentially be okay. But there's some areas of pockets, especially if rates get a little cheaper, where there's opportunity there. And frankly, they just haven't worked over the past few years. Turning to the positioning, I don't think now's the time to be adding to risk excessively. I would be equal to slightly below. We've talked about that before. It was wrong in the second half of 2025. I would still be positioning as such. I think valuations and the spreads that you're getting for taking on bond risk just aren't appetizing at this point right now. It doesn't mean we sell everything and go to cash until things are figured out. That never works. But we should probably be prudent about the level of risk we're taking, take it back to equilibrium, and potentially even slightly conservative of your equilibrium stance. Again, fixed income, look for relative value, but don't chase risk blindly, especially if interest rates come down, right? If we have 1 to 3 cuts, interest rates, especially at the short end, may come down. You're getting less income from that. Don't just automatically assume that, I'll just extend my maturities or extend my credit and get the same amount of income I got before. That's where you can get in trouble. So you have to be a little bit careful about that. We wouldn't be chasing risk blindly in fixed income. I think an interesting spot for U.S. stocks, again, I was saying probably sub-average returns overall, but there's some discount bargains out there. It doesn't mean everything's expensive. One of the areas I think is mid-caps. I think mid-caps have had a pretty terrible 2025 comparatively. They were positive, but they were laggards compared to the overall market. And there's some really good companies in that mid-cap space. I think the valuation compared to the S&P 500, again, on a year basis, this may not work out at all. But I think if I'm positioning right now, I'm looking to maybe add some mid-cap exposure just simply because they haven't worked here for a period. And those tend to be really good companies with really durable growth rates. Those kinds of areas where I'd be looking to maybe add some exposure. International stocks, again, we're going to keep the same positioning that we have right now, maybe rebalance that back to where we were from an approach there. It's too early to tell whether this is the glacial trend I was talking about or just a blip on the radar. So we're going to keep positioning there. We want to maintain diversification, but we're not betting aggressively on international stocks at this point right now. Lastly, on the alternatives, we need to rebalance that gold and silver. I don't mind if you own it. I would not make it a significant component of your portfolio. I would not be adding to it aggressively at these levels right now. I would be looking to rebalance that, enjoy the profit that you took if you owned it. But keep it back to a minimal part of your overall portfolio. It has some diversification benefits. It worked extraordinarily well in 2025. Enjoy that performance, but bring that back, take some profit off. Again, lastly, on the alternative side, I think real estate has some areas of attractiveness, but you got to be selective, especially if you're talking about private elements. So if you're talking about private real estate versus public real estate, really need to know what you own then and know your limitations and know your restrictions. That goes for all alternatives, especially alternatives that have limited liquidity. Know what you own, know your limitations, know your restrictions, know where the soft spots are there. If you need help with that, we are absolutely here for you. Give us a call and we can have a conversation about it. So I hope this was helpful. Again, this is our largest one of the year. This is the longest one we will do. Tune in next month where we will have kind of an update to our path forward and a little bit less robust view, but still a little bit better look at the overall, what's happening, what's changing, have any of our assumptions changed, that kind of stuff going forward. But until then, thank you very much. And I wish you all the best for 2026 and we'll see you soon.